Hello, everybody. My name is Arthur Mrozowski, and I'm a 35-year kind of veteran here in Silicon Valley. Started from just a simple being software engineer, worked myself all through different ladders of activities. Currently, I do mostly mentoring and advising in the life science, IoT, fintech, and media. Welcome to the Venture Capital 2022, and then we have a fantastic panelist here. And let me start introducing you from the way that the list is appearing on the actual program. And I do know that unfortunately Eric from Munson from the Adit Ventures could not join us today. So, but still, in all, we have such a stars of the future thinking that I'm pretty sure that that will compensate for lack of him. But anyways, who we have here is the Peter Davis, a managing partner from Interplay Ventures, and I'll let him talk about himself. He knows himself the best. Chris Ya, founder and chairman of Blitzscaling Ventures, and also author of the Blitzscaling book, which is the must-have that he co-wrote with Reid Hoffman from the PayPal Mafia, or also the founder of LinkedIn. And then we also have Elisa Morales-Hellebo. I'm sorry. It's just is that how it's pronounced?
Yes.
All right. I knew how to pronounce it in the first place, but then I screwed it up. I tried to switch into my English, where if I switch to my Polish, which I'm native Polish speaker, then it was right. So she's a co-founder, GP of Refashion Ventures. And then let me just start the conversation by each one of you, like talking about yourself and then what it is that you do for a minute or two, and then we'll try to expose the the future vision of the venture capital. So again, I would like to start with Peter Davis, which likes to be called MPD. So MPD, why don't you start telling us what's on your plate, and who are you, and then what's going on?
Thank you, Arthur. Hey, everybody. Mark Peter Davis. Nice to meet everyone. I am the co-founder and managing partner of a firm called Interplay. Interplay is a top-performing venture capital firm based in New York City. What's a little bit unique about our model is we've co-founded 8 companies that comprise a 500-person platform at this point. That provide core operating services to entrepreneurs, everything from commercial and health insurance, marketing, leadership, trading, accounting, tax, CFO, et cetera. And it creates a number of synergies with the companies we invest in, making us a very attractive partner to them, because we can help them with introductions, talent, advice, in ways that are not easy to do without a 500-person platform. The net result of that is when we target extremely competitive deal rounds, we have a high success rate of getting access, and then all of that's kind of resulted in strong performance. All of our prior ventures are top 5% Cambridge associates. Our first 2 are trending to 20x multiples. And we've also, in addition to the venture capital fund, have built a multifamily office at Interplay, managing my capital and other people in the tech community, where we're active LPs and direct investors in a number of other funds. I'm long of the startup community. I've been doing this my whole life, more or less. Love it. Duke undergrad, Columbia Business School. Have started large startup communities for both of those universities. I'm an former active blogger who wrote a book called The Fundraising Rules, and now currently podcast and interview the best and the brightest in and around the tech community around the country. Thank you for listening.
All right, thank you very much. And now let me hear a little bit about Lisa's background.
Hi there. It's Morales-Hellebo, and I am co-founder and GP at Refashion Ventures. We are an early stage supply chain fund. We're investing across data, AI, advanced materials, advanced manufacturing, and advanced logistics. We started with a rolling fund on a user list and just started doing our first investments July. Since July, we've done 9 deals and we have another 9 in due diligence. This is because we started by building a global community. So Brian and I, my co-founder, he has about 20 years in finance, built a family office for the founder of Vonage, built a number of funds out of that family office and managed 100 million. I myself am a serial entrepreneur who has scaled and exited multiple companies through Silicon Valley and the like. I have about 27 years in tech by way of Carnegie Mellon, and have worked in Silicon Valley tech, Boston tech, DC tech, New York tech, Puerto Rico tech. I've been through Techstars, built and founded the first fashion tech accelerator, the New York Fashion Tech Lab in 2014, and I serve on the board of the George Mason University Center for Retail Transformation and the Center for Advancing Innovation, and Parallel 18. I'm deeply steeped into the startup community, and so when Brian and I decided to build a fund focusing on supply chain, it's because we were basically the only people we knew that were equally obsessed with this space, and everyone in our community was like, you know what, supply chain is boring, go talk to that person who also won't shut up about it. So we were just, forced into each other's circles by our mutual friends. Long before COVID, suddenly now everyone thinks supply chain is sexy, and we've thought it was sexy for a long time. So we started by building a global community to really bring together the builders and buyers of supply chain innovations, because we recognized there was no space for them to easily do this. In 2017, we hosted our first event, the New York Supply Chain Meetup, and we saw 150 people standing room only. Had to kick people out at the end of the night. Who knew supply chain was such a hot button topic long before COVID. Our community kept coming back, and we've grown since 2017 to 4,000 members on every continent except for Antarctica, and over 40,000 in our global network of what we call our builders and buyers. Our deals have included companies that have scaled and raised over 24 million and were born out of our global ecosystem. So they've come back to us for teeny tiny checks just to have us on their cap table. We are just now starting our institutional fundraise for our $50 million fund in 2022.
Thank you very much, Lisa. Chris?
Yeah, so hi folks, I'm Chris Ye, glad to be here today. And just in terms of my background, I am one of the co-founders of Blitzscaling Ventures, which is based on the best-selling book Blitzscaling, which I wrote with my old friend Reid Hoffman. And the idea behind Blitzscaling is that when you're trying to win a winner-take-most market, the most important thing is speed. And so what we do as Blitzscaling Ventures is we look at the companies that have taken investment from the top 31 VC firms in the world. We find the ones that are growing the fastest, that we think are the most likely to successfully win a winner-take-most market and make piles of money. And then we get in touch with the CEOs and gain access to the deals through them. So it's a pretty simple and straightforward process, but it allows us to work with some of the best entrepreneurs in the world and some of the most interesting and fast-growing companies in the world. And as for my own background, like many of the other folks on this, I've been on the operations side as an entrepreneur and operator as well before turning to the dark side as an investor. Like Lisa, I also actually have a design degree, although I'm not nearly as fashionable as she is. And my own affiliation is I'm out here in Silicon Valley, went to Stanford as an undergrad. I still teach at Stanford occasionally as well. I do have a Harvard Business School degree, so that does give me some East Coast cred. And just glad to be a part of the discussion with you, Arthur.
Thank you very much, Chris. So let's start talking about what the future is, which is just around the corner. And then I would like to start with MPD, a question or topic that is of interest, because the current valuations of the startups, we're seeing like a dramatic shift where even pre-seed monies now for good ideas, people are getting term sheets on a piece of napkins, and as usual, for $5 to $10 million. And I just wanted to ask you, because you probably have a good idea of what are the valuation shifts nowadays in the venture world.
Great question. We're rounding the corner on raising our next fund right now, and so LPs are constantly asking about this. I myself am an LP in another early stage fund, and they did a good job of pulling together some data. And what they had illustrated was that the valuation paradigm has shifted, where seed valuations and rounds look a lot like Series A. The old seed are now the pre-seed deals. So there's this overarching shift. What hasn't moved in lockstep with the valuations are the performance metrics of the underlying companies. So valuations have gone up for no material change in the underlying traction. And so you can look at that as a form of inflation in pricing for sure. I have a couple of comments on it. First thing is, when we look at this shift, this is my third time living through a kind of a boom cycle. And every time there is a boom cycle, there is a flight to hype within venture. The companies that get the most articles in TechCrunch tend to have the craziest valuations, and everyone's trying to do those deals. But there tends to be rational thinking within the market, despite the valuations we're all hearing about and the overarching trend, for companies that are less hype driven. So while valuations are up across the board, we've backed a company that's doing software for hardwood flooring stores in your local strip mall. No one's interested in that. No one cares about it, but it's a great business. And so those valuations come much more, they seem to be affected by gravity in these moments where gravity seems to be suspended. Now, there's an interesting concept that someone said to me, and I'll stop monologuing here in a second, recently, which I really appreciated. We are very sensitive at Interplay to valuations generally, and are very thoughtful about it right now, because I think if you avoid the overhyped valuations, which we avoid, when the market rationalizes a little bit, you'll be in a good position to still generate a large return in venture. It's the people who are gambling on $150 million pre-money seed rounds or A rounds that are really in trouble when the rooster comes home. But there is an interesting comment I did hear from another VC recently that I thought was fairly enlightened. The point he was making was that the return profile in venture has increased in aggregate over the past 5-10 years, right? So where a top decile fund used to be a 3x net, you're seeing higher performance than that almost uniformly. So with that, there's an argument that essentially return or pricing has gone down, returns have gone up in the market. It's attracted more capital. And as a byproduct of it, we're rationalizing the pricing, the returns, to get venture back to a normal risk-adjusted return profile for venture funds. So right now we are seeing not just higher valuations, but higher returns. And I think those two are going to catch up with each other and reconcile. All that said, I think it's still a fantastic time to be investing in venture, as long as you're working with managers that are taking a rational view to valuation and realize they're walking on hot coals when they're running through the market right now. Thank you.
Okay, thank you. I know, Chris, that you developed the Blitzscaling thermometer or measurement stick to actually evaluate the companies, and even the most successful and even money making propositions you guys are throwing out, unless the temperature raises up to the 80 degrees or 80 points out of the 100 scale. Can you tell us a little bit about how you are approaching this valuation phenomena?
Absolutely. And I just want to comment that I think MPD's spot on in terms of looking at what's happening with the market overall. We see it as well in terms of valuations going further upwards. Part of it is supply and demand, and then part of it is also pull from the public markets. The public markets have performed so well that as a result, valuations, even in the private markets, have responded. So I think that that's also a major factor. What we do at Blitzscaling Ventures is we try to take the gut feel out of it a bit and be a little more systematic. So we actually have a system where we look at 7 different factors. We grade them on a scale of 1 to 10. We apply an exponential factor and a weighting factor, and we end up with a scaled score from 1 to 100. And as you referenced, Arthur, we're looking for companies that score 80 or above. Those are the ones that we consider blitz scalable. What's interesting is not that many companies fit this criteria. We look at probably about 1,500 to 2,000 companies a year. That's all the deals being done by the top VC. 50 to 70 of them are going to end up meeting those criteria. So it's a small single-digit percentage. Now, the things that really cause these companies to stand apart, which I think also provides them with some protection against the valuation downside if valuations start to turn, is that they have a strong winner-take-most market dynamic, which means that once they win the market, it's very difficult to dislodge them. And they have a very effective distribution strategy, preferably a capital efficient one, because the whole objective is get to scale faster than the competition. And again, there are certainly companies that go out there and try to buy their way to the top. And a classic example of this is WeWork. But the issue with something like WeWork is you're buying your way to the top of something that's not a winner-take-most market. You're spending colossal amounts of money along the way. If instead you're able to find a winner-take-most market where once you win it, you own it for decades and print money, and you have a capital-efficient way to get there via expansion. We love things like virality, for example, which can drive exponential growth. Then you're in a much better position. So I do think that even amongst the hyped investments, it's possible to find ones that make sense and ones that don't. If we think about a company like what's a classic one is Clubhouse, which was probably the most hyped company of 2020. I don't know if there's any other companies that were more hyped in 2020 than Clubhouse. And I remember we actually looked at Clubhouse. So this is an interesting point. We looked at Clubhouse and they scored high enough on our measures to be considered potentially blitzscalable. Because in theory, if you create a new form of a social network and you build that to the largest possible size, you can obviously make a lot of money. Facebook has shown us that, Snap has shown us that, WeChat has shown us that over and over again. These social networks can be enormously valuable. Well, with Clubhouse, what we did is we actually did what VCs are supposed to do, which is I downloaded the product and I started using it. And I very quickly concluded that people would not continue using this over time because the experience, the product was fine, but the way they had emphasized the community wasn't actually going to attract anyone in the mainstream. It wasn't going to keep them around. And now we see, it's ironic, Clubhouse is floundering. Meanwhile, a whole host of Clubhouse clones that big companies have created are also floundering. So it'll be fascinating to see how that plays out. But it's a great example of how, as an investor, whether you're investing in venture funds or investing in companies directly, you have to do your own homework and think for yourself as well.
I want to add something to that, if that's okay, Arthur. Chris said something really important that I think gets lost when real business people look at venture, right? There's a lot of hype and people gambling and imaginary companies, but even at large valuations, there are companies that justify it and are sustainable, right? So I was an early investor in Coinbase. They had their Series A. And when you looked at that company, yes, there's a lot of unknowns about crypto. But when they showed up, they were experiencing several 100% month-over-month growth rates and real revenue. So those patterns that are out there can be real signal, especially if you see great revenue with growth, healthy margins. Our average investment company we invest in is typically doing $9 million in run rate revenue. By the time they're doing that, we can look at the economic engine and know that it's a sound business. You can get that for a reasonable valuation, all things considered in venture. Markets can go up and markets can go down on the back end, but whether it's a 5X or 7X or 15X, we're going to make a bunch of money.
I have a different perspective to add. So we're a specialist fund. And I think being a specialist, you have an advantage, especially being early stage. Brian and I were specialists in supply chain long before it was sexy or everyone understood the implications of supply chain being tied to not having toilet paper, whatever in their house. So when you're a specialist, it means every day, all we do is eat, breathe, and sleep supply chain. We are constantly having events and salon series with experts in the space. We're doing analysis on deep dives within different segments of supply chain. Supply chains are horizontal, so it goes across every other vertical. Our tagline is the world isn't supply chain, as we're all learning now thanks to COVID. So we focus on getting in ahead of the market and really identifying the key areas that deserve investment and then finding the companies that are building in that space. We can then discover which are best of breed, as we've done time and time again. If Brian and I had money to deploy At the time, we could have gotten into optimal dynamics before they were even out of Princeton's Castle Labs. So optimal dynamics has become pretty well known as being the next evolution of artificial intelligence. It was developed out of Princeton's Castle Labs over 40 years. Brian was working directly with Professor Warren Powell before it was even turned into a company by his son, Daniel Powell. And before they even raised a cent, Amazon offered to acquire them for over 100 million. So we could have gotten into that early if we had the capital at the time. We're seeing more and more deals where our guesses were right based on our analysis before the market.
I have a question,
Yeah.
a quick question for you. So you're on an angel list, a lot we see, so I would say 50% of the funds that we see out in California are angel list funds, where they start at angel list and then they become micro VCs, et cetera. How much of your deal flow comes from angel list or from this 40,000 person
Zero.
network you set up?
Zero comes from AngelList, all of it comes from our network.
By the way, Marty, we on the webcast, the microphone really comes very soft here. Like we can't hear as well as probably you are in your room. Just so you know.
More closely.
Yeah, maybe you can lower the microphone and then speak directly to the microphone, because it's really soft. Okay, great. All righty. Well, listen. I actually wanted to ask you, Lisa. I mean, we were talking about the valuation of the companies and such, but in your experience, you're dealing with the logistics, and then we know that the actual chain is broken, and then I just wanted to find out if you in the 2022 if you have any solutions for in terms of your investments that will hopefully fix up the problems that we all are experiencing right now in the physical world, or maybe even actually in the physical world, because I think the digital is doing just fine.
Sure thing. Yeah, some of the areas that we find most interesting are localization of infrastructure. First of all, let's set the stage that supply chain is the largest operating system to ever exist on this planet. It's never been digitized before, and so it's bigger than OS and computers, everything. We are harnessing the opportunities for investment in that foundation, the railroad tracks, if you will, of this infrastructure. There's a lot of funds that are only pure play SaaS, and we see that that's sort of a blinder on the opportunity of being in cyber physical and IoT and all the data that these proprietary infrastructure plays are deploying that have never been deployed ever in history. So those companies that are deploying this new infrastructure will hold all of the data and businesses that are built on top of them. So localization of infrastructure, distributed micro manufacturing is a really interesting booming space around the world. Thanks to COVID, everyone is starting to claw back their manufacturing to within their local markets or whatever they can. We've seen massive trends where even ocean freight companies that are seeing a massive boom this year are recognizing the impending crash, and that their ocean freight is going to be clawed back, and they're going to have to get into land-based distribution and logistics as well. So everything micro, small is the new big, small businesses tapping into infrastructure to help enable small businesses because of the localization trend. These are all really hot topics for us.
Right. Well, thank you very much, Lisa. And I just wanted to shift back to MPD because I think that he's very much qualified to answer this question. Everybody is talking right now about this new Web 3.0, and that's where everything is heading. I'm here in Silicon Valley. I'm just like bombarded with the different terms and the different deals. What is the Web 3.0? Is that really going to be the new thing that raises up to the AI of the 2020? Can you tell us a little bit more about it?
Yeah. So first, let me level set what Web 3.0 is. So Web 1 was the old days when companies made a static web page that you can go and read. Web 2 was read and write, so things like Twitter, where you can read someone else's stuff, but you can also contribute. And the content actually came from the users of the site versus the company that owned it. Web 3 is about ownership. It's about distributing ownership from one company to a group of people. It's basically taking what existed with a lot of the open source movement for software, which if you're an engineer, you know well, and applying it more to broadly to business. Now, there's a lot of question marks around Web3 right now. It is the topic of the day. There are a lot of people raising funds just around the buzzword. There's a lot of capital flowing towards it, and there is a lot of money being made in it. But it is very, very early. Right now in the Web3 world, we have a lot of infrastructure layer, a lot of people interacting and setting up pipes and systems to make companies that will really rely on Web3 later. But there is very little in the way of the application layer, stuff that we would use. So I think this is kind of like the 70s of computing, right? Investing in it, you know there's going to be something there in the future, but it's not really usable yet. Now, doesn't mean we're going to have to wait 20 years for it to be usable. And I think a lot of money is going to be made along the way because there's a lot of people who are passionate about it, and there's clearly a cult movement around it. So Web3 is about changing the way companies are built. This is the key recap, to where there's someone who comes up with the idea, they start it, but then they essentially give out ownership and responsibilities to a community of people. And those people all collectively build it going forward. So it's a fascinating new paradigm. I think it's an interesting sociological experiment about how humanity can reorganize, right? Do we need to have leadership, government type structures in companies, or can we have an idea that then humans kind of organize around very effectively? So there's a lot that we're going to learn in the next 5 or 10 years, I think, both from a business perspective and sociologically. I do think there are tangible opportunities to make money right now in Web3. And this is something we've done. We've been involved in crypto since 2010. But when we saw it, we didn't jump all the way in and say we're going to be full crypto firm. We remained focused on the broader internet ecosystem. But we thought there was different ways to make money in crypto then, where we could secure a position and share in the upside. So we bought crypto early, 2010. I was buying Bitcoin at $100 a pop. We invested in Coinbase's Series A. We started a crypto mining facility. And we also built one of our service companies that provides insurance. We built the first FDIC equivalent insurance product for crypto companies. So I think when you look at spaces like this, where the core product line has yet to be totally firmed up and finalized, there's bets on the market trend, but there's also picks and shovel strategies where you can buy into things along the way that you think will be good assets to own. Beyond that, there is a lot of gambling going on, and people make a lot of money in gambling and they lose a lot of money in gambling. And I've just never been much of a gambler.
Mm-hmm. And then how's that, excuse me, how's that relate to the NFTs, because that's the new term. Is that totally interwoven into the Web 3.0?
Yeah, so it's really all the same thing, but let me bring it down to English that I could understand. Blockchain is a new type of server for a computer. Instead of having one box where it's saying, hey, so-and-so has this much money in this account versus that account, it distributes that server functionality across the entire web. Think of it that way. So blockchain is a new type of server, just like AI is a new type of software. That's all they really are. What's unique about what's come out of the blockchain world is obviously currencies. And so any money sitting in your E-Trade account or your Chase account, that's a number on a server. On blockchain, that server is just distributed. And more or less, it's the same thing. It's currency. And there's a whole bunch of other little implications. But at the high level, that's all it is. NFTs are taking that same technology of saying, this is a unique dollar that belongs to Chris in his Chase account, and we're going to move it to his E-Trade account, but it's no longer in Chase. And it's showing you that there's this $1 has become an individual entity and it moves. They're applying that same concept to digital objects to show that they are unique. So they're saying, okay, yes, you can copy and paste this photo of a strawberry 1 million times. But all this technology is saying is we're stamping it with technology to say this is the only strawberry that is this one or the first one or whatever that strawberry is that makes it unique. It's a name, whatever. And so they're saying this is a unique item. So that has applications for art where scarcity is interesting. Now, the downside is, right? Yes, you might only the first piece of strawberry art, but doesn't mean they have to stop printing them. There could be 10 billion of them after it. So does that dilute the value? Those are great economic questions. I think there will be opportunities in NFT in particular for things of historical significance, maybe the first CryptoPunk. Those types of things I think will end up being salient from a historical perspective, just as you see art in the Met, that's the most interesting because it related to a Revolutionary War, Civil War at some point through history. So there are those opportunities for sure. Same thing you'll see with baseball cards and basketball cards. The most famous player's rookie card will always be the one that will accrue most of the value. And then after that, it's a long tail. But what this technology is really about is opening up the concept of ownership. So the last thing I want to say on NFTs, why I think it's very interesting, is the business model. The 99th tomato picture I don't care about. What's really cool is it allows creative types to monetize their work. So if you are an artist today and you're painting and you sell the painting, you got paid once and then it's gone. And very often, a lot of the value creation happens when it's sold the third, the fourth, the fifth time. The most interesting thing about the way the blockchain technology is using this distributed server to keep track of everything, that's all it does, to NFTs, is it's allowing NFTs to have basically built-in contracts. And these are little rules. These say, okay, the artist now gets 5% of every transaction on this tomato. And so it creates a real revenue model for the arts. How big that becomes or how significant it is, that's going to have a lot to do with the extent to which people are passionate about digital assets. And while before you roll your eyes and think it's a joke, there's a huge business for digital assets where people work really hard to earn the best sword in some video game, text somebody on a message server, and then meet them in the game to buy it. There's billions spent on that. So that is the primer on what I think is happening with Web3. I think no one really knows exactly how it's going to shake, but there's certainly a step function in progress from a technology standpoint. The applications are on the come.
Chris, I just wanted to ask.
I think Lisa was trying to mention something.
Okay, I'm sorry. Yeah, I guess.
We like it for supply chain. The implications for NFTs and smart contracts tied to supply chain are massive. I think that's the largest application. Art is great, but when we move beyond the 1% that is investing in these NFT arts at such a high valuation, it's really currently a market only serving the 1% of the 1%. The massive business use case is for digital bill of lading, your materials tracking, actually being able to receive a container at a port. I don't know how much all of you know about the supply chain, but right now the ports are being blocked up because there's so many cargo ships that can't dock at one port. There's one crane to take all these massive boxes off of each ship. And even some of the hold up of all of these ships is just having the correct data on what is in each container on the entire ship. So a ship will have thousands of containers, and if one container has questionable bill of lading, the whole ship gets held up at the port. So the use case for supply chain is just massive.
And I'll just add, I just want to add, I don't think I've ever heard such a clear, cogent, and well put together explanation of what Web3 is. So MPD, that was fantastic.
Oh, thank you, man.
And I'm also enormously jealous you did the Series A for Coinbase.
Chris, so I just want to comment on what Mark just talked about. So I think in the gaming space, so gaming used to be smaller than the movie business, and now it's about 10 to 15 times larger. So probably there was about, I don't know, this year, probably around $180 billion of gaming done. Gaming works on something called the freemium model, where about 10% pay for it. So a big part of the people paying for gaming are these people that buy these artworks on game systems. So they're creating NFTs now on this specialized artwork. So the way it is, like, so a guy in the United States might be gaming and it's really important that they have the right skin or weapon or whatever. And they will hire people in India and China to go and create minutes on the game, and then they go and develop these luxurious items that they show that they have assets, et cetera. And those are, you know, digital assets, et cetera, but you're creating NFTs behind them. And so this is a space that is so massive in terms of gaming, and then the people paying for it is about 10% of gamers pay for it, and then there's another probably 1% of that 10% who are spending a vast amount of money. So it's huge, and if they're doing NFTs in it, I expect those just to continue.
I also wanted to say one other thing about Web3 in general, which is, I think for a lot of folks who are traditional finance people, this all sounds insane, right? The VC side already sounds like a scam, and now this is like at a whole nother level. And my comment is, I think it's appropriate to be skeptical, but not dismissive. And what I mean is, if we think about all these technologies that have occurred in the past, different waves, both Mark and MPD and I are old enough to have gone through those multiple waves. I think, Lisa, you as well, we've experienced this before. In all of these boom times, there are charlatans and fools. And the fact that there are charlatans and fools in Web3, the fact that the majority of people may very well be charlatans and fools, doesn't mean that there's nothing there. It just means that there's a lot of excitement about something new. And charlatans and fools are not a sign you have to avoid something entirely, just that you have to be a bit more selective. And I think one of the key ways to being selective, and Marty sort of talked about this in terms of the gaming, the implication is, the thing about blockchain is it does everything, the blockchain, Web3, everything, it's all about the supply side, the supply chain, the authenticity, and so on and so forth. It doesn't magically create demand. And pricing always comes from the intersection of supply and demand. And so if you're looking at these different projects or potential investments, the question you should ask yourself is, where does the demand come from? It doesn't just magically appear because we've built the chain or built the coin.
I love that.
Chris, if I can ask you, just staying on the subject, but go ahead, Mark. I have a question following up on.
I was going to add one concept for anyone who's skeptical on blockchain. We got two mega trends happening in the internet. We have rise of cybersecurity issues. Everyone's hacking. To me, that says the existing technology infrastructure is not good enough. And here comes blockchain, which is a more secure database system. And I think Lisa's right. Like, this is going to play right into supply chain. Any type of asset or record that you need to be done with high fidelity, once they can bring down the cost of processing and reduce the power requirements so it's a bit more ecological, this is going to be the future of database management.
I think there's an interesting crossover also between the creator economy, like you mentioned, just getting your licensing fees for ongoing usage of the same asset. It's, for us, I think unlocking the creator economy is really all about user experience. So it all comes back to design. High five, Chris. Everything is about user experience to gain massive market adoption. And right now, the user experience of all things crypto, blockchain, and NFT is very kludgy to the general population. But I think when we see some companies that are really diving into refining the user experience to the average lay person, we're going to see massive adoption.
So I have a follow-up question to Chris. So with your deal flow currently, do you have any above 80 points or 80 degrees measurements for any of the Web 3.0 companies? Do you have anything that you guys had funded, or are you, since we're talking about the future, are you planning to do anything in 2022 as far as the Web 3.0 is concerned?
So we absolutely are looking in that area. As I said, we are skeptical but not dismissive. And there are a couple of companies we identified early on that we weren't able to move quickly enough on. One of the things we do with our fund is we don't invest in companies when the valuation range gets above $1 billion. And the whole thing there is just, look, we know that the world is full of these wonderful exits, but when we invest, we want to feel like we're going to be able to get a 20x on each investment. Otherwise, there's no way to get the kind of 20x that the MPD gets on his whole fund. So with a 20x on each investment, if you're investing at a $5 billion valuation, you're saying, I believe this company is going to be a $100 billion company, which is very hard to achieve. Mm-hmm. So we did see there are two particular Web3 deals that we looked at that we really liked a lot, but they were just beyond where we could get in. and feel good about the valuation. Not that the companies themselves won't work, but just the valuation didn't work with our model. One of those was OpenSea, which is the primary marketplace for all these digital assets. And there's obvious network effects there, right? Exchanges are natural monopolies. And that's the kind of thing we would love to buy into, but we couldn't buy into at a price that would make sense given the way our fund works. And the other was a company out of Europe called SoRare that was one of the first to sort of pioneer how are we going to do these digital assets and NFTs. And what they did is they combined it. This is all about creation of demand. They combined it with fantasy gaming, specifically fantasy football, so that is to say European football or soccer, and they signed a bunch of exclusive deals with the various football clubs, the prominent football clubs in Europe. And so that was another one where like, okay, they really have a clear understanding of how demand is being driven, but it was one where it was so hyped that within a month of their first announcement, or maybe 2 months of their first announcement of funding, they had already raised money at $1 billion valuation. So, you know, sometimes they get away. That's okay. The world is full of great deals, but we are absolutely looking in this area.
Great, thanks. Quick question from the audience. NPD, somebody's asking if your fund is still open for the investment.
Yeah, we're having our first close on January 15th. And so we're happy to entertain conversations with folks. We're really looking to strengthen our LP partnerships and work with other great people. So anyone who wants to get in touch with me, I'll put my email in the chat, I guess.
Sounds good. Then let's talk about I don't know, Marty, how much time we have, because we shifted off from we started a little bit late, so I think we have about 20 minutes still on the panel, if I'm correct.
No, there's about 5.
5 minutes? Okay.
We'll talk fast.
We'll talk fast. So I will then, since I'm not going to raise any topics right now to create the blitzscreening of any sort. So let's start with Lisa and kind of summarize. Each one of you could have like a minute and a half, or let's say, to just say, how do you envision the 2022 from your perspective?
I think 2022 is going to be the year of supply chain. I mean, 2020 certainly put it on everyone's radar. 2021 sort of, you saw the business pain points and everyone's starting to scramble, and huge enterprises realizing they need to invest in earlier stage innovation because the later stage companies are even too archaic given the current set of crises. Our thesis around supply chain is based on, we're in a state of climate crisis. We see supply chain and the climate crisis as being two sides of the same coin. And until we fix the root cause of the climate crisis, you're not going to see any stability in your global supply chains. So anything that is an innovation to actually create localized, sustainable, circular, on-demand products is going to heat up even more so. And we're going to see more and more funds, as we have been. I mean, Bessemer, we love getting validation on our thesis. Bessemer just came out with a white paper that was echoing a paper or a booklet that Brian and I wrote in 2019. Our booklet is called The World of the Supply Chain, and Bessemer just came out with a whole white paper on the thesis of supply chain being the new fintech. So people are waking up to the opportunities here. A word of caution is to, if you're going to deploy capital into a space that you think is interesting and hot, like supply chain, look for a specialist. There's a lot of generalists, especially if you're looking to get your money into early stage supply chain. It is not an easy subject to dabble in because there are so many moving parts. And if you're not living and breathing it every day, you're only looking at one individual deployment that may be incremental, and you can't see the barriers to entry 2 or 3 tiers down the chain. So look at a specialized fund like Refashion Ventures, who knows their stuff in supply chain and the opportunities. It's supposed to be scaling to over a $15 trillion market by, I believe it was 2025. And we're just getting started, the tip of the iceberg of opportunity here. The companies of tomorrow that are going to be the Google, the SpaceX, the Amazon are just being formed today in supply chain innovation.
Thank you very much. Chris?
So there's a fantastic prediction. There's a fantastic statement that says it's difficult to make predictions, especially about the future. But I'm going to go ahead and do it anyways. Where I look at 2022, I feel very bullish. And the reason is I think that the mega trend of all mega trends is, of course, COVID-19. And I think obviously people continue to have worries about this. But I think that we have incredible vaccines, including one from my business school classmates company, Moderna. And it looks like they're going to be able to be effective against the disease. We have great therapeutics that are going to be available on the market soon, which I think people are underestimating. The fact that there will be pills that you'll be able to take if you get COVID-19 that will just keep you from ever going to the hospital is a remarkable change. And I think the world will be heading back to normal. I had hoped that this would occur in 2021. Obviously, it didn't, but I think that means there's an even greater overhang of people who really want to go and travel and buy things and enjoy life. So I predict a very large consumer boom in 2022. I would recommend staying invested. You shouldn't listen to me, of course, because past performance is no guarantee of future results. But I am very bullish on 2022, and I personally am looking forward to being able to see people more in person rather than on Zoom.
Sounds good, Chris. Mark?
I think no one knows what's going to happen in 22. I think we're living in a world where a lot of the people who are supposedly experts are saying it's going to be a financial boom and it's going to continue. I hope that's right. Our mindset, and I think you're probably hearing from everybody on this call, is that we're being very opportunistic in the moment, but we're waiting for the next failure of the economy. And I don't know if it's coming in 3 years or 4 years or next month, but we are taking that into account, how we think about valuations, capitalization, company planning. And so we are both taking advantage of the moment and being aggressive, but we're trying not to get over our skis in any way where we're going to trip if we have to stop suddenly. And I think I see Chris and Lisa nodding, like that's in the mind of everyone who's a serious financial investor now is, hey, when it's good, my buddy said, let's hope the music keeps playing. But I think you have to keep that phrase in your mind and emphasis on the word hope. So be ready for the opposite. Thank you everyone for listening. Thank you to the panelists for doing this with us, and Arthur for having me.
Thank you very much.